Hey everybody, welcome to chapter 3. There you go. To make sure I could fit it so you could see everything on the slide. That's important. So this chapter is going to cover the adjusting process. If you remember in chapter 2, we learned the very beginning steps in our accounting cycle. And I'm going to take you back here. These were what we covered in chapter 2. We learned to evaluate source documents, which I'm abbreviating on this. We had some kind of paper trail that tells us what each financial transaction was about. Bills, receipts, bank statements. Then we recorded the transaction in a journal entry, which is found in the journal, and those would be in chronological order. We ensured debits equal credits. We picked the right account. We practiced doing that. Once we did the journal entry, we then posted to the ledger, meaning each account that was listed in the journal entry, we went to their individual ledger page and included the amount that the account was adjusted by. Then at the very end of the chapter, we learned what an adjusted trial balance is. Once all the transactions in a fiscal period were captured, every ending balance for every account, every ending balance on their ledger page was dropped onto the adjusted trial balance. And the goal of the unadjusted trial balance was to make sure that debits equal credits. Okay. That phase of the cycle, let's say about a third of the cycle, is completed. We're going to learn the next phase. The next phase is chapter 3, the adjusting process. So I'm going to include the steps here now, and then we're going to go through them on the slides. So after you've captured all actual transactions, the next step is to go through, as the accountant, you know which accounts need to be adjusted, not because there were documents, but because they fell in that category of they were deferrals or accruals, and we're going to learn what that is. We did see in chapter 2, we learned a little bit about accrued payables, accrued expenses, that falls in this category, and our prepaids, that also falls in this category. So after we're done with everything from chapter 2 and we know what we have to do, we are going to, just get this again, make adjusting. Oh, let me get, let's see if, I'm going to erase that. Hang on one second. Okay, we're going to make, this may be a little, here we go, adjusting. It's hard to write. I'm doing this with my finger. I don't have a stylus. Adjusting journal entries. Okay, that's different than the journal entries up here in the second step. Then we post to the ledger again. So whatever adjustments we made, we have to go to the ledger page for those accounts and post them. And then we're going to prepare, our second trial balance, which is now called the adjusted trial balance. Okay, the first one, I'm going to abbreviate that TB for trial balance. Okay, that's the cycle so far. It's hard to draw on this pad with my finger. So there's also an accounting cycle tutorial in MyLabs. Be sure to use that and the resources to practice this. But this is where we are for now. So we're going to start here with our adjusting entries. I'm going to give you the intro, and this is what will cover these 3 steps in chapter 3. So why do we have an adjusting process? Well, basically, there are 2 forms of accounting. One is called the cash basis of accounting. One is called the accrual basis. In this class, we're learning all about the accrual basis of accounting. But let's define both and give you examples of both. So under the cash basis of accounting, it means if you're a small business, if you don't have publicly traded stock, then sometimes someone comes into your store and they buy a loaf of bread. If you have like a little general store, when they put the cash on the counter or they pay you with cash, that's when you include it in revenue. right? And when you pay bills and money leaves your bank account, when you pay the rent to your landlord, that's when you record an expense. So under cash basis, it is when money physically and literally comes into your hands and leaves your hands, right? This is not allowed under GAAP. So all the public corporations that we're, from the point of view we're talking about in this class, we cannot use cash basis accounting. It's easy, it's fine for a really small shop, it's fine for non-public, but it's just not allowed under GAAP when you're preparing financial statements. Let's come over here to accrual because this is what we have to learn. And I mentioned this in my last set of videos. Revenues are recorded when we perform our service or we deliver our good, regardless of whether the customer gives us the physical cash now or they owe us at some future period. So whether we collect the cash or not, it's irrelevant. Under accrual basis of accounting, we accord revenue when we earn it. Likewise, expenses. We're going to record expenses when they're incurred, not when we pay the bill for that expense. Doesn't matter if the cash left our pocket and we paid the bill. It matters that the expense happened. For example, it matters that we used our electricity during the month of November. And even though we're not paying that bill till, let's say, January 1st, we have to record a utility expense because it happened. And we'll do that, let's say, in December before we even pay the bill. So revenues are recorded when earned. Expenses are recorded when incurred. This is what is accepted by GAAP, and this is what most businesses use. It is a more accurate picture of revenues and expenses. Okay, as a quick sort of something to look at, we're going to look at the Smart Touch Learning paying $1,200 for insurance. They're paying it for the next 6 months. So under the cash basis, there's two separate columns here. Let's look at the left first. If I made a $1,200 payment under the cash basis of accounting, right, I am going to record that expense on the day I pay it because that's when the money left my pocket. I am not using the insurance until 6 months, 1 month at a time have passed. I will use that slowly, a sixth of a time over 6 months. But under the cash basis, the cash left my pocket, so I record an expense of $1,200. Under the accrual basis, I pay the same $1,200. However, I am going to record in journal entry format. This is just to show you the amount. At the end of May, 1 month is gone, 1/6. So 1,200 divided by 6 means $200 a month. On May 31st, $200 has been incurred. On June 30th, another $200 has been incurred, so on and so forth until we use up the whole $1,200 by October 31st. That's the accrual basis of accounting. One more quick example from a revenue standpoint. The company receives $600 for services. They receive it on April 30th, and they're going to perform the services over 6 months. So remember what I said, we didn't really earn revenue till we perform the service, but under cash basis, we still are going to call it revenue on April 30th. We're going to create a journal entry that says debit cash $600 and credit revenue $600 April 30th. Under accrual, however, same $600 comes in, we do our work evenly over 6 months. We're only going to recognize $100 of that $600 each month as we earn it. So this is spread out more. So let's say my fiscal year ends July 31st. My financial statements for this company will only show $300 of income, while over here, under cash basis, it will show $600, right? This is the more accurate picture.